Welcome to 2023. This is the up or down for January. I'm sharing a clip in this video from our perspective seminar that we put on that shares more of our thoughts and tries to bring perspective to our clients. That's going to be sent out in an email or will be posted on social media when it's ready. This is Tyson Ray, financial advisor at Form Wealth Advisors, where we exist to help make life better for our clients and those in our community. The market finished up in January, still in its trading range that we expected to be in, and it finished up because the expectations the Fed won't be as aggressive as we were thinking in December with this rate hike that's coming any day now. One of the things that we have to recognize when we have a year that has both a negative return or a low return is that some of our investment strategies or some of our recommendations may need to adjust based on what happened. And what do I mean by that? Well, historically speaking, the markets earn about a 6 to 8% return in the type of models that we recommend. And that's an average, and we don't necessarily get that every year. And last year, with the return being negative, we didn't get it. And again, for our clients that live off of that recommended 4 or 5% withdrawal rate that we tend to advise clients on, the portfolio didn't give us the return to generate that extra funds. And so what does that mean? Based on last year being a negative year, what can you do to improve your financial situation for 2023? It actually may be a part of the solution of bringing inflation down, which is to pause some spending, allow the portfolio's opportunity or time to grow back before we go back into those portfolios to pull money out to live off of or to accumulate other things. For two reasons. One, if we don't have to sell with the accounts being down, we'll have more shares to appreciate if and when the markets recover. And two, by going without, we might be able to purchase whatever it is we're trying to purchase at a better price if inflation comes back down and we start finding values again as these excessive prices in both real estate or automobiles or borrowing money become more favorable in the next 12 to 24 months. So as we look out into 2023, let me share with you why I'm not worried about our long-term investment strategy for our clients that will be patient and allow time to pass. And it's because even with the recession, what drives growth in portfolios in the market is often tied to these companies' earnings, which kind of makes sense, right? If the businesses are making more money, then the business that makes more money should be worth more. And though we might have a recession, this earnings, which they track in the past and project out, companies will tell us this is what they think they're going to make next quarter or even out to the next year. And when we look at what the earnings expectations are in 2023, we are expecting that the earnings are going to come down. They're going to be less. Again, why? The Fed is slowing down the economy. But let me help quantify specifically what that is. If we take all the companies that are publicly traded in that market, those 500 companies, and we take all of their shares and we take all of their earnings and we boil their earnings down to earnings per one share. So if we could buy one share that represents all 500 companies, how much money does that one share earn of all those companies' earnings? So in 2021, those earnings went up 49.6%. Almost 50% from one year to the next. And then, shockingly, in 2022, they were projected, and they're still collecting the data, they were projected to only grow at 6%. And in 2023, and this is the if we have a recession, they may go down. The number actually for 2022 is expected to come in about $220 for that one share. And then the numbers that are coming in for 2023 are anywhere from 220 flat to maybe about 200. But you hear recession, I hear recession, people hear recession, you would think that number's going to zero. And it's not. A recession is slowing down, or we're not compounding quarter to quarter, but it's not going to zero. It's just a slowing down. And yet, when I look at the same analysis from different firms, 2022 is less than 2021. 2023 may be flat, like I just said, and yet some expectations for 2024 is that we would grow about 10% in earnings. And so what am I saying? If earnings are expected to be flat or go down a little bit, well, the market's priced in the down a little bit. That's why the market's off its highs. And so if the earnings are flat for the year, I expect the returns, the portfolios to be flat, which may be better than the fixed income market because if the Fed keeps raising rates, as they did in 2022, raising rates gave them some of the worst returns, worst losses in history. And in fact, history shows earnings grow about 6 to 7% a year over time. Interestingly enough, the market return ends up being about 6 to 8% over time. And so those are the fundamentals that I'm counting on. And yes, this may be a year, or last year was a year that we had to slow down a little bit because of how well we did. But it doesn't mean it's stopping. It doesn't go to zero. It doesn't mean we're not going to consume anymore. For many Americans, this increase of inflation is actually going to increase their Social Security check, and that can be permanent. Additional dollars to spend into the future. But the word recession doesn't mean game over. It means we're resting from the advance that we had. And it's a purification, it's a reset. And there's maybe going to be a lot of people that are going to panic. And there's definitely a lot of people that already have. But I'm not panicking and I'm not worried. And if you are, let's have a conversation about that. The purpose of these up or down videos is to try and bring a little understanding about what you should be doing with your long-term investments based on what is going on. And so this is Tyson Ray, financial advisor at Form Wealth Advisors, where we exist to help make life better for our clients and those in our community.